so much to talk about. Where do we begin? I think it's safe to say that I think investors and markets thought we were going to get something different from President Trump. Ira, let me start with you. What are we seeing in terms of the rates markets? What are we seeing in terms of financial markets from investors about where we're maybe going from here, the reality of it?
Yeah, so I think we should talk a little bit about today, because I think today is very interesting with West Texas Intermediate crude up and everyone saying, oh, look, the bond market's hardly moved. But then I dig into the details of this and I say, okay, the 2-year Treasury yield on the everyday 2-year bond is only down 1 basis point. But then you look at the TIPS market. And look what's going on in like 5-year TIPS and 2-year TIPS. Those yields are down dramatically. And typically those yields go down primarily when you worry about either growth or inflation being high. And guess what? We have both of those things today. So when you look at inflation expectation and what the market's pricing for inflation expectation, that's up 10 basis points today. Right, so you look at 2-year inflation swaps, like they're higher by, as I check my Bloomberg terminal now, by about 5 basis points today, but that's well off yesterday's low.
So Ira, is that not being reflected in the Treasury market? Is it only being reflected in TIPS? What's going on?
Yeah, so that's my point, right? Yeah. You have this disconnect,
Why
right?
is that?
So well, I think in large part because the way the market is pricing this is they're pricing it through TIPS and inflation expectations as opposed to the Federal Reserve hiking interest rates, right? Because if the market was pricing for the Fed to be really going to hike interest rates anytime soon, like the ECB we think is likely to do this coming month, would be to have higher yields, and that's not what's happening.
Robert, come on in on this, because I think the thing we're thinking about is, with Treasuries, I mean, the concern that at some point higher energy prices, if they stick around longer, that ultimately can impact growth. And I'm just curious where you are, because what I'm hearing from Ira is the potential for, are we talking about stagflation again?
Right. We're definitely talking about it. But the fact of the matter is, I think we've learned a lot since COVID. We had a huge increase in interest rates. The economy was pretty resilient. You had Silicon Valley Bank. The economy was pretty resilient. Fast forward last year, you have this massive increase in tariffs, tremendous uncertainty. The economy is pretty resilient. So now we're looking at high energy prices, right? And they're up. The curve is still in backwardation, so people are optimistic it's going to come down.
Right. But
the fact of the matter is the economy has shown a lot of resilience. So I think the market is looking at the Fed and saying, they may not be able to cut rates. They're going to have to drag their feet on this. But it's not like other countries where, hikes are priced in. So Fed has a dual mandate. They're going to be very well considered in this. But I think the market is sensitive to that. If we get minus 100,000 payrolls tomorrow, then it'll be different. The market will be looking at recession possibility.
Is that likely?
I don't think so.
Okay.
I don't think so, because that's my point. Is the economy's been pretty resilient.
Yeah. And
I think, frankly, we've seen a lot of stability in long-term interest rates. Once they got to this 4.25 level, late 2022, they've been range-bound around that level. So short-term, there's a tremendous amount of uncertainty. Longer-term, the inflation expectations, things seem to be pretty stable.
Ira, do consumers have that cash to protect themselves from these higher energy prices? I spoke to Chime's CEO earlier today on Bloomberg TV, and Chime is a company. The average, the typical person they deal with has a income of around $75,000. So it's certainly a part of the economy that is more affected by higher fuel prices. And he said fuel spending has risen 25% amid this war with Iran.
Yeah, and certainly, energy prices have, and obviously that's a pretty large part of the consumption basket. The way that I think about these higher gasoline prices, it's really a tax on the consumer. So if it acts like a tax on the consumer, then it will slow the economy. Now, we talk about stagflation. We have to be a little bit careful on how we define that, right? Because you could have a slower economy and not a recession, right? And we've had a pretty robust economy, and I agree with Robert that the economy has been somewhat robust, but a lot of that robustness has come from two things. One is investment spending, things like AI and the like, and then the other is, when you look at all of the jobs that have been created, and actually 2 times the number of jobs that have been created in aggregate have come from one sector, and that's the healthcare sector, right? With a lot of people in home healthcare and the like. So the fact is that when you have a one sector economy, I think it is at risk. I'm a little bit more pessimistic maybe than Robert is on the U.S. economy, but we don't have to have a recession. And but you could have a significant enough slowdown that it certainly feels like that. Like think about 2015 when you had the exit of the energy investment boom, or think about 1994. I always bring up that one because that's when I got out of grad school and I had a problem finding a job. But luckily, my wife found a job and we were all good. But nonetheless, if you do have a significant slowdown, it can feel similar to a recession, even if it never shows up in the actual numbers.
Robert, what about, like, you look at, obviously the global bond market, but I do think about disconnects between what some other central banks might be doing, because this war is certainly impacting Europe, Asia differently than it is the United States. We've talked about that a lot. So if we have disconnects in global central bank policies, which does happen, it is still, we're all kind of connected. So I'm just curious do we see parts of the world go into recession or significant slowdowns? Does it ultimately feed back to the United States in some way? People buy stuff from the U.S. They do business with the U.S. So I'm just...
Right. Well, I think, the United States ultimately is more of the world's customer. And so I think that, the slowdown here will have more impact on other economies than their slowdown.
Which we saw with the GFC.
Yeah. Now, in terms of Europe, they are looking at possibly some rate hikes there.
Yeah.
And they may have a bigger bite from the energy side or not. So far, their gas prices are up, but it's been measured. We're going to have to see what comes from the government on these things. There's very little appetite out there for recessions. Is there going to be a subsidization coming from the government in order to offset some of the costs there? But I think that, the U.S. is, for better or worse, in some respects more secure in terms of resources, in terms of geography. We will have more defense spending. Who knows, maybe we'll have some fiscal stimulus, before we get to the elections. And so I think we're seeing some firmness in the dollar. But
you definitely sound much more optimistic. Like, I'm curious, Ira, because you are a little bit more pessimistic. Do you have a question for Robert? Like, as you listen.
Well, not really. I mean, the one question I would say is, how do you invest some of this in the global fixed income market, right? Because, like Carol said, it's possible that the ECB is going to be increasing interest rates, whereas the Fed's probably on hold.
Right.
Is there a curve trade or something to do between the U.S. and Europe, say?
Right. Well, I think that, when I look at the markets more broadly, look at cash, look at equities, look at bonds, and what investors have been doing. Investors, without changing their asset allocations, have ended up with a tremendous amount of equities. So they have a lot of exposure to downside risk in the economy. Equity valuations are fairly full. And I think that's a tougher call. Do you stay with that, an above average allocation to equities? When you look at cash, what we've seen is money fund balances in the United States have continued to go up. Cash balances for investors, for return-seeking institutions and individuals appear to be kind of high.
Yeah.
Bond allocations are low. So I think people are underallocated to fixed income, and I think that's why we're seeing resilience in terms of long-term yields.
Why do you think we see all that cash on the sidelines?
Because cash has been a great performer. But so if you think about it, since late 2022, the 10-year gets to 4.25. We're still at 4.25. You've been all over the map in the price of a 10-year. You could have ridden cash all the way up to 5.30, down through 4.30. Now you're at 3.60. So you're a little bit thinking about should you go out on the curve and so on. But the risk-adjusted returns of cash have been phenomenal.
I was under the impression that cash is trash, Ira.
Well, the Sharpe ratio of cash has been quite good, right? I think that's Robert's point. And the other thing that I would note with all of the cash, I talked to some of my colleagues in equities, and they say, "Oh, look, there's all this cash on the sideline that needs to be deployed." In this case, I do agree with Robert that the people are underinvested to fixed income, right? To buy bonds in general, but this cash on the sidelines that's in all these money funds and the like, they're not going into equities, right? This is instead of holding bank deposits that yield zero.
That's so interesting, right? Because I would imagine that some of it is people who are saying, well, to your point, that equities seem fully valued, so we'll have money in a money market fund or in some sort of bond fund, and then when we see an opportunity in equities, we'll go there. But that's not the pattern?
What we're seeing is money is going into bond funds. A lot of money is going into bond funds. Money is going into stock funds. But the amount of money going into money markets is almost equal to the sum total of those two. So apparently there's a lot of investable assets. It's piling up in those forms.
It continues to pile up. I feel like the last couple of years we keep saying, when is this going to come in? But it just continues to grow.
Yeah, so for the most risk-averse investors, the cash has been very competitive with Treasury returns. But for more adventurous investors in fixed income, your high yield, your emerging market hard currency debt, and even your corporate bonds over the last few years have done very well. So I think that's why, there is overall support for the market, despite the tremendous short-term uncertainty.
Robert, when it comes to global bonds, though, where is the money going? And I'm curious, it's been interesting when you watch the dollar, which we saw it under pressure, then we saw it move up, certainly. As of late, I think about the impact on the emerging market world. So where have you guys been specifically in global bond funds, seeing money going in or out?
In terms of the flows, it looks to me like there's two offsetting kinds of flows that we have seen since the election in November. There's a big drop in the dollar, but the money is coming here. So what's going on? We're seeing foreigners buy U.S. debt securities, buy U.S. securities, but the amount of money that's coming in is small relative to the total stock of U.S. dollar assets held. So apparently people have been hedging the currency exposure of their U.S. investments, but net, where are they putting their money? It's still coming here.
And I think here's a reason for that, right? When you look at where the flows are coming from foreigners into the U.S. in terms of treasury bonds, corporates, equities, and the like, it's foreign institutions have been selling treasury securities, or at least running off their portfolios, but private institutions continue to pile in, right? And those are the economic sensitive investors and the price sensitive investors. So those are the ones who are more likely to hedge their currency exposure. Central banks don't, because that's not really their mandate. And also private investors, they buy 10-year treasuries, 30-year treasuries. Central banks don't do that. Central banks buy T-bills 2 years, 3 years. They don't buy the long end. So they don't own a lot of market risk.
All right, so let's push this forward a few months and talk a little bit about Kevin Warsh and the economy that he inherits if he becomes Fed chair.
Which is kind of interesting.
I don't know. Is it a when or is it an if, Robert?
I think it's a when.
When is it?
Okay.
And I don't have a great call on that. Let's say this year. But
Okay.
I think the more interesting part will be, what does he do?
Yeah.
And I think what I'm supposed to say, what I'm supposed to think, is he's going to come in, he's going to get the Vulcan mind meld on the committee, and they're going to cut rates regardless of what's going on. But we've seen this in the past, and we've read of in the history books.
Even if inflation is ticking higher?
That central bankers come in and they do the right thing. When you're in the seat, and honestly, if the dollar's going up and that's getting inflation down and long rates kind of stay where they are because the inflation outlook is solid, maybe that's an acceptable opportunity for everybody, especially if you're putting your signature on the dollar bill.
What if it's after midterms and they go to the Democrats? Would it still, does that change? It just got about 15 seconds.
I'm optimistic on the markets long term, but in terms of the picture for human beings in politics, it could just be increasingly chaotic.